শুরু করা যেতে পারে।
Start, sir. Start, sir.
শুরু করব?
Yes, sir.
Okay. Hello, everybody. This is my second live session. I intend to discuss about financial statements very slowly so that any residual doubt should be eliminated. Before I start, there are some questions already in the Google Docs, so let me briefly talk about them. One question is, what startup in India can be considered for excellence in business model innovation and go-to-market strategy? This was raised by Arun Mishra. Well, this is a very involved question. In fact, a lot can be discussed about them. Most importantly, whenever you think of a new business model, meaning you think of creating a new business, you should identify the pain point. It should not be that Tom, Dick, Harry have been doing some business, so that is the main business ideas and you should chase the same business. So there may not be a formula that this is the business model. For example, now EdTech, EduTech is the in thing, meaning every investor is kind of willing to invest education technology based startup, particularly after the successful beginning of Byju's. But then how many Byju's can be there in the marketplace? And not that all the startups are becoming as competitive as Byju's, as excellent as Byju's. So there may not be a direct answer as to which business model to start. Whenever I talk about business model innovation, I give examples of the say Fanindra Sama. He came up with a portal for bus ticket booking because of his personal experience. He suffered the pain. So it was kind of empathy with many people. He empathized with himself and he, in the process, empathized with many other guys who really suffered in the absence of a portal for booking bus ticket in advance. That is how he came up with Red Bus, the idea of Red Bus. But then another guy cannot start another portal of similar to Red Bus or something, and there may not be many companies of the same kind. At the same time, it is not also true that if one company is starting in one domain, it's not that other companies are not relevant. For example, in analytics, there may be more than 100 companies who are doing wonderful business, and there may be another 500 that will be wonderful business model, provided they identify their niche. You cannot be competing in the same marketplace with many players in the market. You should be able to identify your own niche, like say analytics has relevance in umpteen number of domains. So if you find something relevant and something not adequately addressed, definitely analytics, artificial intelligence, machine learning are the futuristic thing, and there are more chances of being successful compared to if you start something traditional, like for example, you start an e-commerce business. That is kind of a very traditional business. If somebody has money and somebody can hire talent, one can start. Whether they will be successful, that will depend on many things. It's a network-based industry where you have to be able to register many users. On one side, you register many users. On the other side, you register many vendors. And there is a kind of a cascading effect, meaning more vendors will lead to more users will lead to more vendors, and the story will go like that as long as you can manage well. But if you are a technologically advanced or say matured person, then you can think of something which is based on emerging technology, particularly in the face of COVID. and this pandemic that we are in, there are many business models that have more potential compared to other businesses. EdTech is one which has almost like unlimited potential, provided you come up with something innovative. Like in this digital age, everybody has access to the best content. So if somebody is offering the best content, all the customers will try to join there, meaning there is no geographical boundary that you start something in your own city. People from other cities may not be available, or people from your city will have the only choice to join your company, something like that. There is no such advantages. In fact, it is the advantage of the best. If you are the best, you have the advantage that you can attract customers from all geographies, even from global marketplace, not just from your own country. Then health tech is another one people are talking about. Many companies have started, particularly saving the data of the patients, or say customers or people, and then making them available right at the time when it is necessary. Maintaining secrecy is another domain which is kind of emerging, and it will remain vibrant for a while. Then online pharmacy, things like that are definitely good. Then there is no formula, as I said. I can't say that it will be suitable for you. You have to really identify a pain point that should be in a domain that you have expertise in. Okay, so stay connected. Maybe we can discuss this offline. Send me a mail with your telephone number, then we will chat maybe on WhatsApp or something. Vinith raised so many issues. One is, okay, I'll not read the whole question. He says, information and options, choices, etc., to be made at the time of starting or creating a venture, kind of overwhelming. So for a first generation entrepreneur, this may appear menacing, meaning it's kind of looks like there are every chance that you will commit a mistake and things may go haywire. So what to do, whether to hire some professional like a chartered accountant or a lawyer? Well, for registering a company, you should not do it yourselves. You should take help of either a lawyer or a chartered accountant. A chartered accountant perhaps is a better person to register a company. But remember, the moment you think of starting a company, you don't go ahead and register a company. You should register a company only when it is absolutely essential. For example, you want to raise money either from an incubator or an angel or venture capitalist. Venture capitalist comes much later. And if they insist that you have to have a private limited company, only then we'll invest. Only then you think of registering a company, because registering a company requires a lot of money. And you do not know what is going to unfold moving forward. It may so happen that tomorrow itself you change your mind and you think of starting a different kind of a business. So at the beginning, things are going to be highly volatile, and registering a company requires a lot of money on an annual basis. So initially you may end up spending 35,000 rupees for registering. Then every year you have to pay something like 20,000 rupees, partly to the register of companies, partly to chartered accountants for preparing the balance sheet and filing all the documents. You have to make digital signature, what not. There are a lot of expenses. Maybe more than 50,000 rupees will be spent annually just to maintain the company. So I would suggest that don't think of register a company immediately. If you are doing an ordinary business, just go ahead and start the business. All that you need is a trade license and a GST registration. So just have a trade license. If you are in municipal corporation, approach to the municipality with a valid rent agreement or some letter, no objection letter from the premises owner where you will start a business. Suppose you are starting a business in your dad's garage or somebody else's garage, let him or her give you a certificate that he or she doesn't have objection if you start a business, start and run a business in that particular premises, whatever that is. So with that, you can approach to municipal corporation and get a license called trade license, and you may start even without registering a GST, registering for GST. GST registration is mandatory if your turnover is above 20 lakh rupees. This data may not be absolutely accurate. You just check on the portal. So once before that, you don't really have to register for GST. So have this trade license, start a business. Now you don't have to think of many things when you start. At the beginning, just take training, do experiment. Like if you're thinking of something like creating a huge brand, and huge means you are making a plan of 5 years or 10 years, or maybe a going concern. Going concern means there is no end to it. It will remain perpetually existing. That is absolutely fine. But you should gain expertise moving gradually and moving forward. You will have a lot of opportunity to change your business course. In fact, majority of the founders who are highly successful, they started many startups before they actually became successful. So they started one business, they were not successful, they changed it, started another, etc., etc. So whatever they started with, that did not remain with them for a long time. So you don't have to worry too much about too many things. You just try to gain experience. Suppose you want to start a software company. If you start a kind of an e-commerce company at the beginning, selling something, say selling used books or anything at the beginning, will not be useless at all. Like it will give you some ideas as to what are the things that goes on, what is meant by what is a payment portal, or say payment gateway, etc., etc. But then of course you should not do too much of experimentation. If your business is a software, is likely to be a software business, start making small softwares of different kinds, and then try to sell them, understand the market, understand payment gateway, understand how things move, etc. And gradually you will gain expertise and you will be able to educate yourself with this experience. So eventually you may start a different business for your core software activities, but then the experience that you gain by running a small business is kind of priceless. It will give you many insight, like what Vineet has been asking, that it looks like it is too involving. So I would suggest that you start some business that is so easy to start without really incurring a lot of expenses, without really wasting a lot of time. So gain that experience. You will network with people. That is going to help you, and that is going to help you make a decision as to, before registering a company, what you should do, how you should do. Next question: what happens when a company goes bankrupt? To the grant that they received. Once you receive a grant, you don't have to repay. So you don't have to worry much about what will happen if you go bankrupt. If you go bankrupt, then nobody is going to chase you to return the grant. But then complete the process. When you receive a grant, there are conditionalities that you have to submit utilization certificates. So do that. Audit your account and then submit audited utilization certificate in time. Don't do that after you go bankrupt. Do that whenever you receive the money and you utilize completely, submit that report and you are done. Nobody will chase you as to why you failed. They will not ask question, but they will definitely like to know, because they gave the money. They have to write in their file as to what is the status of this business. They will write that it is a bankrupt company because of this, but then that information is important. Now, his last question is, should a student start startup and become kind of without completing the degree, I won't suggest that. The statistics about student leaving studies and starting spin-offs and becoming successful are not many. Data do not suggest that this kind of students are very successful. If you are enrolled in an engineering degree course, my suggestion will be that you complete that with flying colors, because you always need something as a backup. In fact, you need that confidence that I have something to fall back upon. But you should not be too complacent that let this business, whatever happens to this business, I have something to fall back upon. That also is not so good. But then it will save you from devastation. It will save you from distress, from getting depressed. So let there be a degree in your hand. And I would also recommend that you join a job, work for a while, get to know the corporate culture, get to know how information flows in an enterprise, get to know how to recruit, get to know how salaries are made, how accounting is done, how marketing is done. Most importantly, if you get an opportunity to work in a marketing position, nothing like that. Marketing is by far the best part in a startup. If you can sell anything, that is the best quality. In a discussion with my students, Mr. Arjun Malhotra, who was a co-founder of HCL Tech, he said when they started HCL Technologies, long back, I think 1977 or so, that time there was no computer. They themselves invented part of the computing and computers, and they were thinking whether there will be customers or not. His peers, his partners said, we will make sure that people are making inquiries. Then Arjun told them that if you can send me some people who are prospects, I will make sure that everybody becomes a customer. Meaning that if I get one person who is expressing his willingness to understand what this personal computer is, I am capable of closing a sales with that person, meaning I'll definitely sell a computer. That is the spirit with which startup should work. So it is the marketing capability. If you can convince a person that you have a value proposition and a person has every reason to buy your product, that is the best quality that can make a startup successful. That is the most important driver of success. So if you get an opportunity to work in a company in the marketing division, perhaps you gain the best expertise, best experience. But take it seriously. Even if you work for a month, take it absolutely seriously. Make this a piloting of your startup, something like that, meaning you hone the skill of marketing to the maximum, meaning you exploit this opportunity to understand how to market, how to convince the customer about value proposition, what is a value proposition, what do customer want, etc., etc. Okay, so working in an enterprise, maybe in a startup, marketing of a startup is even better because you understand startup culture, the challenges that a startup goes through, etc., etc. So an opportunity to work in a startup even without salary, without salary, anything, that's a great opportunity. Before you start your own startup, you should not think that having a good product that you think good will ensure that you have a winning proposition. Never. It normally doesn't work. Normally, we do not understand what customers are going to want, are going to buy. We go by some hypothesis that does not work. So rather than feeling confident that feeling confident that I understand what customers are going to buy, it is always better to understand customers, understand value proposition, and then talk to them, get your idea validated, have some marketing skill, and then start the business slowly. And then as you gain credential, gain traction, then move fast, so that you have huge growth to attract investor, attract new employees, etc., etc. The last question I see in the Google Doc is difference between incubators and accelerators. This I have covered thoroughly in my video lecture. Nevertheless, since there is a question, I'll just elaborate. See, incubation and incubators. Incubators do incubation. When incubators are some organizations, majority of them are educational institutions. They start something by the side of the institute where they offer infrastructure for budding entrepreneurs. If you have an idea, you'll be given infrastructure and some money with all other infrastructural facilities, like first of all a space, then other infrastructure, utilities like internet connection, water supply, etc., power connection. This is a place where you incubate your ideas and then it transforms into a product, commercial product. The time when your product is ready for commercialization, you move out of the incubation cell and then go to a regular office space or factory premises. That is the objective. This may run for maybe 1 year, 2 years, 3 years, depending on progress of your idea, progress of your prototyping, etc. So period is slightly long. They give some money. Incubators give you some money, maybe seed capital, depending on potential of your business, depending on their comfort, their risk perception, etc. And they may or may not give you a mentor. Of course, they will always try to connect you to the customers, to the mentors, etc. On the other side, accelerators have a very short-term perspective, unlike incubator. Accelerators will select a bunch of people who are trying to develop products in a similar domain in one batch. So acceleration is done in batches. So suppose there is an accelerator by the name XYZ, then they will hire something like, not hire, select something like 25 startups. Say they are working in Android application development. They will take these guys and keep them in one premises. They will provide small cubicles with a small sum of money for maintenance. And then they will provide them mentors. The reason for similar kind of startups is that they can arrange the same kind of mentors for mentoring many startups. Not only that, these startups will get mentored by their peers, meaning one startup will mentor another, depending on who can solve whose problems. Because their problems are similar, their challenges are similar. So it makes sense to have similar kind of startups. Not only that, they can invite investors who are interested in similar kind of businesses. So everything together, they lead to wonderful synergies. That is why they invite similar kind of startups to be accelerated at the same time. Normally the program runs for a couple of months to 3 months, maybe at times 6 months. But as the name suggests, it's an accelerated process of growth, meaning you grow from an idea or maybe from your early prototype into a commercial level operation very quickly. That is why it is acceleration. And on the last day of acceleration program, there will be something called demo day, when the accelerator will invite a lot of investors, and the startups, all the startups will have an opportunity to pitch before investors. Chances are very high that all the companies, all the startups will get some funding or the other. So it's kind of a marriage made on the demo day. And you come out of accelerators with funding on one hand, experience on the other, and the product which is matured. So you are all set to start your startup. That is what is accelerator. So I'll move to the main topic. I think I have already spent a lot of time on this. Uh, Yeah, so this is our skeleton of financial statements. I have the data of a particular year, say some operational data here. I hope you can see my Excel sheet. Let me check. Okay. And then this is the balance sheet as on 31/10/1990. Sorry, 2090. Okay, so first thing first, we are going to prepare our profit loss account statement. The YouTube actually is echoing. I don't know why. Okay. So, okay. So for profit loss statement, as I said, you have the data given about the current year's performance, meaning operational data. Using the operational data, you have to prepare the profit loss account, then balance sheet, then cash flow statement. So we start by estimating the gross profit. So if you remember the formula, gross profit is nothing but sales minus cost of goods sold. So we have to estimate the cost of goods sold because sales is known. See, all those data that are on the left side are given, meaning at the end of the year, you have the general ledgers where all these expenses will be available, meaning throughout the year you have recorded the transactions. So you have this data available, like you have paid rent of 60 during the year, advertisement expenses. This is the total expenses on different occasions. You have incurred different expenses. These are the sum total for the year. Like for say purchase of goods during the year, you have purchased a total of 1400 worth of goods. Similarly, you sold 2000 worth of goods during the year. So these are sum total of the transactions that you made during the year. So using this data, we are going to estimate gross profit. So we start by recording the sales first. What is the sales? You use the formula is equal to here sales. Sale of goods is sales. So this is the sales. Now you have to estimate the cost of goods sold. And you already know the cost of goods sold is nothing but the goods that you consumed during the year. Goods that you consumed. What is the goods that you consumed? You consumed whatever goods that came to you from the previous year. This is a running business. So when you close the business last year, some stock remained in your godown or in your shop. And that is what is the closing stock, closing inventory in the balance sheet. You look here, in the balance sheet of 2019, we are actually preparing the data for 2020. So we'll populate it here. So for the closing stock as on 31/3/2019 is the stock that you could not sell in the last year that became available as on 1st of April 2019, meaning at the beginning of the current year. So that is the opening stock. You open the khata of current year with the closing stock of the previous year. So opening stock is nothing but is equal to, it comes from here, previous year's closing inventory. So if you have not noticed, this is the balance sheet of the last year, which you prepared in the previous year. This is last year's balance sheet. We are going to prepare this year's balance sheet. Okay. So we have opening stock. Then purchase during the year. Pretty simple. These are straightforward. What is the goods that you purchase during the year? It is here. Purchase of goods. So you just pick up using formula. So 1400 is the worth of goods that you purchased. 60 rupees is the worth of goods that you inherited from previous year. So total how much is available is equal to this plus this. It's 1460. That is the goods available. Now, always remember that whatever goods available to sell, you don't sell all the goods. Some goods remain unsold as on the last day of the business. What is that? That is available in your stock ledger, where you write closing stock. So you try to find out what is this closing stock from this data. Look here, this is the closing stock. So you just pick up the data from there. This is the stock that remained unsold. So how much you sold is equal to, these are the stock which are available minus this that you could not sell is equal to this. This is the cost of the goods that you sold. This is the cost of the goods that you sold. So this is the sales. This is the cost of the goods that you sold. What is the gross profit? Gross profit is nothing but sales minus cost of goods sold. So gross profit is equal to your sales minus cost of goods sold. This is the gross profit. As simple as that. Okay. Now, if I say what is gross profit margin, this is nothing but is equal to gross profit divided by sales. Everything is based on sales multiplied by 100 is the gross profit margin. In our case, our gross profit margin is 30.5%, right? 30.5%. Now, if let me shift it slightly down just to differentiate. Now, once you have estimated the gross profit, next is to estimate operating profit. What is the formula for operating profit? It is nothing but gross profit minus operating expenses, that is operating profit. So we have the gross profit here. If we can estimate the operating profit, then we'll deduct operating expenses, then we'll deduct operating expenses from gross profit to get operating profit, right? So how to estimate operating expenses? We have discussed that, but you should remember that depreciation and amortization is very much integral part of operating expenses. So before we start adding up operating expenses, it is better to estimate depreciation. And you should remember that land is never depreciated, building is depreciated, and machinery also is depreciated. So building and machinery will be depreciated. So let us see how to estimate depreciation. There will be several questions in the final on depreciation, on estimating operating profit, gross profit, and whatnot. Balance sheet items, cash flow statements. I think there will be not less than 25 questions out of 100. So you should listen very carefully. how to estimate depreciation. One is, I said for land there is no depreciation. Now, while estimating all this, you can start populating the balance sheet. When you picked up closing stock data, that become the closing stock of the current year. So in the balance sheet here, closing inventory, you should populate the closing stock right at this point of time, so that you can prepare the profit loss account and the balance sheet simultaneously. So what is the closing stock? You put equal to here and pick up the data from here. So we populate on the data. You should always populate using formula, so that later if you change the data, nothing remains unchanged. Everything is changed and you are absolutely updated. Did we use any other data here that could be populated here? I don't think so. So we are up to date. Now about building. So, okay, before building, you should talk about land as well. Should I write this value over here? That depends whether we have purchased any pieces of land during the current year or we sold any land. So you have to just browse through here. You should read all the items to remember what we have bought and what we did not. The first is payment of rent, advertisement, purchase of equipment, salary, fuel cost, insurance, employee benefits, purchase of land. So we have purchase of land, closing stock, transportation expenses, maintenance, legal expense, purchase of goods, construction of factory shed, purchase of truck, license, amortization, repayment of loan, trade receivables, etc., etc. So you should just browse through all of them. If possible, you can identify which of them are operating expenses by changing their colors. Like for example, plain payment of rent is an operating expenses. Advertisement, operating expenses. Purchase of equipment is a long term. But let us first identify operating expenses. Salary is an operating expenses. Fuel cost, operating expense. Insurance, operating expense. Employee benefit, operating expense. Just remember, all expenses that can be categorized as expenses and not cost are part of operating expense except interest. Any money invested in fixed asset, long-term asset, are not expense. They are cost for acquiring capital asset. They are not expense. So bearing those where you invested money for creating long-term asset, any other expenses are part of operating expense except interest. So in that sense, purchase of land is creation of long-term asset. Closing a stock, it's balance sheet item. Closing a stock goes to gross profit estimation. So they cannot feature again in operating expenses. So this is already done. Closing stock is already considered. Transportation is operating expense. Maintenance, operating expense. Legal, operating expense. Purchase of goods has already been considered among gross profit calculation. So we don't consider it again. Construction of factory shed is a fixed asset, long-term capital investment. Purchase of truck, similarly, long-term capital. License and registration, operating expense. Amortization is an operating expense, like depreciation. Repayment of bank loan is not related to operation. It relates to balance sheet item. I'll explain later. Trade receivable is a balance sheet item that remains. This is something not connected to operation, meaning you buy something and some payment remains outstanding. So that is a balance sheet item. You should acquire this knowledge gradually. Telephone bill payment is an operating expense. Purchase of telephone is not, because this telephone remains with you for a long time and it's a capital asset. Telephone bill, sale of old machine, no. Interest to bank, no. Sale of goods is already there in gross profit, so let us not consider again. Purchase of computer is a long-term asset. Audit fee is operating expense. Loan raised is not related to your operation. Loan is loan that you raise for either procuring long-term asset or inventory or something that depends on long-term loan or short-term loan, but it is not part of operation, so it doesn't come here. Trade payable is a balance sheet item. Traveling expense is an operating expense. Stationery is operating expense. Company pays dividend is not related to operation, that comes after estimating profit. Founder's contribution directly goes to the balance sheet. Company pays income tax. This is estimated after estimating profit before tax. So definitely not part of operating expense. Outstanding in short-term loan, that is a loan that is outstanding in the bank, not related to operation. Postage is related to operation. So this is operating expense. These are all operating expense.
So can you please zoom in a little bit?
You can actually identify what are the building asset. Okay, before that, let us complete with land. So earlier the land was 200. This year land should be earlier land because you have not sold any, plus whatever land that you purchase. You remember we purchased a land of 200. So this becomes, total becomes 400. So we populate another data in the balance sheet. Let me see if there is a question in the YouTube. Okay. Project or future projects. How to bring expertise in the skill, concept, learn from this course, approach, accelerators, incubators. Okay, zoom it a little bit, it's not visible. Right, thank you. This is important information. So yeah. Now we were estimating the land. Next is building. Now just notice how we do that. Building is equal to whatever was the value in the last year. What value was there? 400. Plus whatever building you procured during the year. So we start from here and we see whether we have constructed any building. Purchase of equipment is not, purchase of land is not, closing stock not, construction of factory shed is part of the building. So we add this with that, previous year's balance. Purchase of truck is a machinery, bank loan, trade receiver, purchase of telephone, sell, purchase of computer, fresh loan, nothing is there except sale of old machine. We sold old machine valued, book value 47. So we should deduct that because this asset no longer remains. That is why we should deduct that. And then press enter, we get whatever is the building book value just before closing of the business. Now we have to depreciate this value. This is the depreciable value. Whatever is the depreciation rate for building, suppose I offer you, it's not written here. Suppose I write here that depreciation for building is say 5% and depreciation for machinery is at the rate of say 10%. So we have this data. So right here 0.05, right here 0.1. This is the rate of depreciation. Okay, so we can directly multiply or you can put it as percentage. Now this is the building value. Building will be depreciated at the rate of 5%. So okay, I just jumped one step. Last year account is equal to, you should get it from the balance sheet, that is 400, it comes here. Purchase during the year is equal to construction of factory shed, plus if there is any other asset, you should keep on adding till you complete. So let us delete this part. Then sale during the year or something. I will not write so much, there's no space. Now you sold is equal to 47 somewhere, this one. So the total asset is total building assets is equal to last year account plus purchase during the year minus sold during the year. So you get it. Now depreciation is equal to this multiplied by rate of depreciation, that is 0.05. Nothing but this. I add it here so that later if I change the depreciation rate, this will get automatically effective. So another thing that you should remember is this is the total assets, depreciable asset, and this is the depreciation rate, total depreciation. Now if you deduct depreciation from the asset, you get net value or book value as at the close of the business. So book value is equal to total value minus depreciation. So it becomes 373.35. We will not go by decimal point, we'll approximate. So whatever that is, building value as on 31st March 2020 is equal to, just pick up this data, write it here so that in future we change the depreciation, or maybe we add some fixed asset. For example, suppose for experiment you add construction of something. So here I write construction of factory building or office building or something, say 50. So here your here rather than 393, your purchase will be added with the new asset that I have added. What is that? Purchase of truck. I have added construction factory with this one. So you just add this two and the purchase becomes 90 and total building asset becomes 441. Depreciation changes, book value changes, and so is here the value also changes, 421.85, 421. Okay, so that is the beauty of using formula. You obviously know. Now this goes to the balance sheet and we get the depreciation. Now we can add this depreciation with other operating expenses to get the operating expense. Now we start with machinery. Last year account is here, plant and machinery 700. So is equal to, use the equal to sign and we pick up plant and machinery from here. This is the last year's value. Purchase during the year. So we have to now pick up one by one. Purchase of equipment is 1 plus purchase of land is done, purchase of good is done, construction of factory shed is done, purchase of truck is part of equipment, so we add this. Then purchase of telephone is another one, we add them. Then sale of old machine. Oh, I'm sorry. Sorry. I deducted this from building asset. That was a mistake. Sale during the year, there is no sale. There is no building sale. So this should be modified. Anyway, luckily we have not done any other things, any mistake. This is last year purchase during the year. Let us go back to the equipment. Purchase of equipment is 120 plus purchase of truck plus purchase of telephone plus sale, purchase of computer plus fresh long-term trade payable, dividend, founders contribution, standing, no other things. So we can remove the plus sign from here and enter. So purchase of new machines are 197. Sale of old machine is equal to 47. here. You pick up from here. I'm sorry, I just made a mistake. These are not, this is machine, not buildings. So what is the subtotal? Is equal to your previous year account plus this is the purchase minus sold. So this becomes 850. What is the depreciation? 850 multiplied by 10%. This is nothing but 0.01 and you get depreciation as 85. So what is the book value of asset? Is equal to subtotal minus the depreciation. So this becomes the book value of the machinery as at the end of the business. So this value goes to plant and machinery here is equal to this value. So we have populated one more data in the balance sheet. At the same time, we have the value here and the depreciation. Total depreciation is how much? Is equal to depreciation of machinery, plant and machinery plus depreciation of building. This is the total depreciation. How much is the amortization? Amortization is the expenses that you incurred at one point of time. You did not show that as operating expenses, but you capitalize that. Like this 500 has been capitalized. Every year you are going to amortize a part of it, meaning you are going to take a small part from there and put it under operating expenses. That value goes from here and the outstanding goes down till it becomes zero. So we have actually mentioned here amortization is 50. So we can very well write here amortization is equal to 50. So we don't have to put it in red because otherwise there will be double calculation. Sorry. Okay, I hope you have understood up to there, up to here. So I'm moving very slowly. This is the objective of this class. Now we'll estimate the operating expenses. We have stopped short of estimating. So operating expenses is equal to, now we'll add up all the expenses. Before we add them up, let us add these two. One is depreciation plus amortization. Otherwise we may forget. Now we start from here. Payment of rent plus advertisement plus salary plus fuel cost plus insurance plus employee benefit. Because I have converted into red, now it has become very easy for us to pick and choose. Plus maintenance plus legal expense, B14 has been added, plus license plus telephone bill payment plus electricity bill payment plus audit fee plus traveling plus stationery plus postage. So we are done. All these constitute the operating expenses. So operating expenses is 496.5, 0.5 because of depreciation. We can eliminate depreciation, this 0.5 thing, if we change the value of maybe of machinery. Rather than 490, let it be 500. Then depreciation will be a round figure, the building thing, 5525. So instead of say purchase construct factory shed, rather than 40, let us make it 50. Now it is round figure, so we are kind of better off. Okay, so this is operating expense. What is operating profit? Is equal to gross profit minus operating expenses is equal to operating profit. We get operating profit. We deduct interest from operating profit, we get profit before tax. So profit interest is equal to how much? Is here interest to bank loan is 50. So that leads us to profit before tax is equal to operating profit minus interest is equal to profit before tax. Okay, whatever. Now we have to pay income tax. The company pays income tax at what rate? 20%. So we pay income tax is equal to this into 0.2. So again, we have some fraction. We can perhaps eliminate the fraction if we have 100 somewhere. So let us reduce the interest to some extent so that we have 60, say 70. Say we write interest as, where is interest? Interest to bank loan. Instead of 50, let us write, say 47. Oh, 47 makes 66 PBT. We need 4 more rupees, so it should be 43. 70 rupees, so income tax is 14. Fine. I have just changed the data for convenience. So net profit is equal to profit before tax minus income tax. Profit before tax is this, minus income tax is 14. So we have net profit of 56. Now we pay dividend. How much dividend we want to pay? Here. The company would like to pay dividend of 20. So we pay dividend is equal to whatever is here, we just pick up from here, and then after payment of dividend, whatever remains, that becomes the retained profit that goes to the balance sheet and gets added to reserves and surplus. This is equal to net profit minus dividend is equal to 36. Okay. So this is another data we should immediately update the balance sheet with. That was reserves and surplus is equal to previous year's reserves and surplus plus retained earning, retained profit. So this becomes another data in the balance sheet. So we get this data as well. Now, see, at the same time, we can populate, let us populate everything together rather than one by one. Cash in hand will be populated from cash flow statement. We cannot do that. Trade receivable, we already have that, is equal to, which is not related to previous year's data. It comes directly from the ledger. So whatever comes directly from the ledger will be available here. Trade receivable is equal to this. Just pick up the data. So we have populated trade receivables. Total current asset cannot be done unless this data is here. That is cash in hand. So let us forget about that. Total non-current asset. Land we have, building we have, plant machinery we have, preliminary pre-expenses. This is equal to earlier year's value minus whatever we have amortized. We have amortized by 50 rupees, so that goes down. So whatever remains, that becomes the new preliminary pre-operative expenses. So total non-current asset can be added here, or we can just, sorry, is equal to, yeah. So we have this data, but we do not have this subtotal unless we have the cash position. Now we have equity and liability. Owner's equity, that is fully paid equity, was 638. So this year it will be 638 plus if there is any new investment. So we have to come here, look at here. Founders contribute new equity capital of 200. So we should add this with the previous years and we get 838. 638 plus 200, 838. Reserves and surplus is already there. So total owner's equity is nothing but this plus this. We already have this data for final. Now let us see whether we can populate all of it before we go to prepare cash flow statement. Trade payable. I'm sorry, I made a mistake here. This is trade receivable. Where is it? Yeah, trade receivable. Did I copy trade receivable or trade payable? That is important. Trade receivable 85. No, that is right. No mistake. Similarly, trade payable also can be picked up from there because this is a balance sheet item. You get it from general ledger that is to be given. So is equal to, let us see whatever is trade payable. Trade payable is here 105. So it comes there. Short-term bank loan, this also is a balance sheet item and should be available in the general ledger or from the bank. So it will be here. Outstanding in bank loan, short-term bank loan is here. So we get this data, 250. I didn't pick up. Short-term bank loan is equal to outstanding and short-term loan. So we get that data. Subtotal is equal to nothing but this plus this is two data. These are short-term liabilities. Long-term liabilities. Long-term loan is equal to previous year loan. This is different from short-term loan. For long-term loan, you have to start with previous year loan minus if you have repaid anything. So you have to see whether we have repaid anything in the long term. Repayment of bank loan is 5. So this should be minus. And plus if you have raised any new loan. So see if you have raised any new loan. Repayment is gone. There is no new loan. So we delete this plus sign and enter. So this is the new loan. We have already got it. Then subtotal of long-term loan, subtotal of liabilities plus subtotal of short-term. So this becomes subtotal of liabilities and total equity and liabilities is equal to this subtotal plus equity, owner's equity. So this is the liability side and this is the asset side, but we do not have cash data. That is why it will not match. So nevertheless, let us write it down. So total current asset will be is equal to this plus cash. Cash we do not have the data. So it is 155 and this is building, plant machinery, preliminary. This is amortization. This is total non-current asset. Total asset is equal to non-current asset plus total current asset. See, these are not same. This should be exactly is equal to this. Why they are different? Because we are yet to populate the cash position. This will come from cash flow statement. So what is the time? Let us complete the cash flow statement. It will be better. We will do slightly fast. Cash flow statement, the format is already there. You can get this format from anywhere. So I will not discuss about the format. First part is cash flow from operating activity. This starts with net profit. So is equal to whatever is the net profit, not the retained profit, but net profit, this one. So we populate it here. Then depreciation, we populate total depreciation from here. So depreciation is populated. Then we populate amortization is equal to, you remember amortization was 50, this one. So we have populated amortization. Now receivable, change in receivable, it is not the receivable. So change is receivable. Payable also, it should be change in payable, not really payable. So whatever is the change, let us see whether it is increasing or decreasing. Receivable was 75 in the previous year. It has gone up by 45. When receivable goes up, this is nothing but cash outflow, because to make receivable you need money. So this is equal to this one minus this one. So automatically it becomes negative. Change in receivable, if receivable goes up, then it is a positive cash flow, meaning we have got some cash from the guys who send us goods on credit is equal to trade payable. This minus this. Here payable has gone up. No, that's the reverse. I'm sorry. Trade payable is equal to that was inventory. Did I make a mistake on inventory? Yeah, this is inventory. So inventory, if it goes up, it is utilization of cash. So it should be this minus this. So minus 10. Trade receivable, also the same thing. Creating trade receivables requires money, that is y is equal to this minus this. So you get a negative value. Whereas trade payable, if it goes up, then it is cash positive flow, cash flow positive. That is why it should be done the other way around. This is equal to this minus this. So we have a positive cash flow here. Now you make the total. Whatever it comes with sign, meaning negative, positive, or whatever. From investment activities, we have invested money in the land, we have invested money in factory building, we have invested money in equipment, in truck, in telephone, in old machine. We have received some cash by selling and in computer. So let us populate everything. Investment activity. Land, how much of land we have bought, that much of money has gone out. So purchase of land is here. This money has gone out. This should come as a negative sign. So you write it here, you can give negative sign or in some way you can do. Then factory. If we have sold many factories, there will be cash flow positive. But if you have sold, if you have constructed factory, building, etc., that is cash flow negative. So this is equal to, we start with a negative sign, then whatever we purchased, say we add them up. So purchase of land is gone. Construction of factory sheet, this is negative, minus construction of building, construct factory building. If there is any other construction, that also should be minus. But if there is a sale of building, that should be plus. Thankfully, there is no building sale, etc. There was just two factory building and shed construction. So this is the equipment is equal to whatever money we have invested for buying of equipment. It should come there. That is a negative cash flow. So let us see purchase of construction factory shed. This is purchase of equipment minus, because equipment are all negative cash flow, minus purchase of truck is a minus because cash went out. Then purchase of telephone is a minus because cash went out, minus purchase of computer, money went out, minus okay, there is no other equipment. So we sold some equipment for 47. In that case, the money actually came in. So this should not be minus, rather it should be plus. The money that came is sale of machine. So you just add them up and see whatever is the net value. Oh, sorry. I just completed everything. Don't do that like that. But it's okay, meaning you can have just one entry. So I am eliminating all of that because that I have considered. So let us eliminate out of that. I have done in one stroke. So I'm not keeping them here. This is the net cash flow from equipment. So total is equal to this plus this plus this. So this is the total cash flow from investment activity. Now financing activity. If you have invested any money in the equity, that comes here is equal to the company founders brought in 200, it comes here, and it is a positive cash flow because money came into the company. Long-term loan. we have to see whether we have raised any long-term loan. I think we have not raised any long-term loan. Oh, we have raised here, but that we did not consider here by mistake. So short-term loan, long-term loan. In here, we have to add the long-term loan that we raised. Fresh long-term loan raised 50. So that becomes change. That is why I always use. So long term, we raised some loan, we repaid some loan. Whatever is the balance, that should come here. So whatever money we raised that came in, so that is a positive cash flow from fresh long term. Whatever we repaid, that goes out, so that is a negative cash flow. So that should be deducted. Repayment of bank loan. There is nothing else here. That is the only cash flow from investment active long-term loan. Okay, so actually I did a shortcut. Let us forget that. Fresh long-term loan raised is equal to, you can do it elaborately, there will be less possibility of a mistake. 50 just comes here. And then fresh long-term loan. In that case, you have to write repayment of long-term also. Long-term loan. What is the repayment is equal to, repayment of long-term is here, so write it there. Now, short-term loan, you have to see whether there is a change in short-term. This is different than long-term. I've been telling repeatedly, long-term loan and short-term loans are treated differently. Here, short-term loan, look at how is it treated. This is equal to, you have to see whether it has gone up or down. If it has gone up, then it is positive because we have received more money. If it goes down, then it is negative. Short-term loan from bank, so we start from here, minus whatever was the balance last year. So we have a difference of day. Now, if you have paid any dividend, that is a negative cash flow. So it is done like this. Whatever is the dividend that we paid is here. 20 rupees of dividend we paid as negative. What is the subtotal of financing activities? Just sum them up. Financing, it starts from here. So this also is included. So 335. Whatever is the total is equal to cash flow from financing activity plus, it comes with sign, cash flow from investment activities plus cash flow from operating activities. Total is here. So total becomes 89. Now, in the previous year's balance sheet, there was some cash. We have to pick up that data. Cash in hand is 85. Pick up that data. Total becomes is equal to this plus this. Total is this. This 175 comes here is equal to, this is the cash in hand. This is the cash in hand. So it comes here and then this value changes. This total changes. So eventually this also changes. There is some 10 rupees of gap somewhere. This is the total asset 2419 and this is 2409. We made so many changes on the fly. Some 10 rupees is missing from somewhere. So otherwise this 2409 should match with 2419 squarely. Let us see wherever it is missing. So it cannot be here. Let us say 10 rupees wherever we have 10 rupees. It's not here. Okay, I think that happened in cash flow. Maybe we made mistake somewhere in the cash flow. This is 70, this is 60, 10 rupees. 85, 75, difference is 10 rupees. This has gone up, so it is cash flow negative. This has gone up, cash flow negative. Then trade payable, this has gone up, cash flow positive. 105 minus 97, 5 plus 3 is 8 rupees, and that is a positive cash flow. Everything is right. Now here we have depreciation, amortization, inventory, all the items are there. land we have, factory we have, equipment we have. Factory we have 2 entries. Equipment is 150, is it right? 150. Depreciation is how much? 85. Total of 110. How much you have taken? 110. So equipment is 150. New equipment minus 47. Let me just check the equipment part. What is the time? 19. Not so much late, so we can afford some more time. Equipment was, we can even pick up data from here. Total equipment was 197 minus 47. Subtotal was is equal to 197 minus 40 is 150. So I have taken 150, so that is right. That part there is no mistake. Then we deducted 47. That is a positive cash flow. 150 equipment how much is this? Other equipments. There is some mistake here because I have taken equipment again. 017 is where? Sorry, it is 017, meaning this one plus 016. This one plus this one, land, factory and equipment. So did we deduct 47? $47 is what? $47 is B25. In this, we do have B25. So we have taken that as well. So there is some 10 rupees here and there. I am not able to identify immediately. Repayment of long-term loan is fine. Fresh long-term loan is 50. Okay, yeah, I got the mistake. Repayment is actually negative because you are using money for repayment. So this should be negative. Repayment of bank loan meaning cash is going out, so this should be negative. So it becomes 164 and our cash in hand goes down to 164. Our total becomes 202409 and this is also 2409. That is how your balance sheet must balance. The liabilities and asset side must balance. There is no reason. See, I kept juggling, I kept changing the numbers, but if you are doing everything rightly, then there is no chance of mistakes. And it is very easy to find out wherever you make a mistake. Like there was a mistake of 10, and because it is 10, 2 multiples of 5, it is easy to identify mistake. It took maybe 3-4 minutes, but then not a big deal. So whenever you are preparing a projected balance sheet or profit loss account, suppose for a startup or something, you should start from sales. And then if you want to make sales of certain amount, and then how you're going to change gradually the other items that you can do. So in the next session, maybe I'll try to do a projected balance sheet. That is not part of the syllabus, but then that will be a good opportunity for you to learn. Many of you will be preparing projected balance sheet profit loss account. So I'll take up that in the next live session, perhaps depending on whatever is the demand. Maybe if some people want me to discuss particular something, then I'll discuss that. Otherwise, I will be discussing this portion. So I don't see many questions. In fact, there are no audience. I'm just talking to myself, it looks like. So we'll call it a day now. Thank you for listening.